Let me tell you something about the market that most men learn too late, if they ever learn it at all. The market does not care about your opinion. It does not know you own shares. It does not know you are impatient. And it most certainly does not move because you need it to move. I learned that the hard way. There were times when I believed I had to be in the market to make money. I felt idle standing aside. I felt foolish watching prices move without me. And so I would jump in, not because the market invited me, but because my ego insisted I participate. Have you ever done that? Entered a trade not because it was right, but because you were tired of waiting. That is how a man pays tuition. Let the market come to you. That is the lesson. It sounds simple, almost lazy, but it is neither simple nor lazy. It requires more discipline than constant action. A trader must understand that money is not made in the buying or the selling. It is made in the waiting. The tape, or today what you call the chart, tells a story. It shows you where the public grows excited, where they grow fearful, where they are trapped. Price leaves footprints. Trends do not begin and end in a single day. They build. They pause. They test conviction. Your job is not to predict every turn. Your job is to recognize when the odds lean clearly in one direction. And that only happens when the market is ready, not when you are. You see, most traders reverse the process. They wake up and ask, "What shall I trade today?" That is the wrong question. The right question is there anything worth trading today? Do you see the difference? One question assumes action. The other demands justification. The market spends most of its time in confusion, sideways, choppy, full of noise. It is designed to exhaust the impatient and reward the patient. If you trade every wiggle, you will find yourself rich in commissions and poor in capital. But when a stock completes its preparation, when accumulation has been done quietly and price begins to emerge with strength, that is when the market is coming to you. You need not chase it. In fact, if you chase it, you often arrive late. I have said before that the big money is not in the individual fluctuations, but in the main movements. A man must sit tight. That is not a slogan. It is a principle of wealth. Consider this. When a stock breaks out of a well-formed base with volume expanding and price holding above prior resistance, what is it telling you? It is telling you demand is finally overwhelming supply. It is telling you that stronger hands are willing to pay higher prices. Why would you rush in before that evidence appears? Waiting for confirmation is not weakness. It is professionalism. The same is true on the short side. When distribution shows itself, when rallies grow weaker and support levels begin to fail, the market is giving notice. But it does not shout. It whispers first. Lower highs, heavier volume on declines, failed breakouts. Are you listening when it whispers? Or are you too busy trying to forecast tomorrow's headline? Let the market come to you means this. You do not trade because you are bored. You do not trade because others boast of profits. You trade when price aligns with your rules and risk can be clearly defined. Risk, that is the foundation. Every trade must begin with the question, where am I wrong? If you cannot answer that before you enter, you have no business entering. The chart always gives you a line in the sand, a prior low, a key level, a structure that invalidates your thesis. That is your exit if the market proves you mistaken, and it will prove you mistaken often enough. The difference between a gambler and a speculator is not courage, it is preparation. When you wait for the market to come to you, you are waiting for clarity. You are waiting for a structure that offers asymmetry, small risk, larger potential reward. You are waiting for momentum to align with trend. You are waiting for the path of least resistance to reveal itself. Most men want excitement, but excitement in trading usually accompanies uncertainty. Calm trades are the profitable trades. When a true trend begins, it does not feel frantic. It feels steady. Pullbacks respect support. Breakouts hold. Volume confirms strength. The market behaves rationally within its own logic. Have you noticed how the best trades often feel almost boring once you are in them? That is because the hard work was done in the waiting. There is another reason to let the market come to you. Preservation of capital. Capital is a trader's inventory. Without it, you cannot participate when real opportunity arrives. If you squander your capital on mediocre setups, what will you have left when a genuine leader emerges? When a broad market trend turns? When conditions align across sectors? Opportunity favors the prepared account. A trader must think in terms of campaigns, not individual skirmishes. When the general market confirms a primary uptrend, higher highs, higher lows, indexes reclaiming moving averages with expanding participation. That is when you press your advantage, not recklessly, but decisively. And when the market deteriorates, when leading stocks break down, when rallies fail quickly, when breadth weakens, that is when you protect. Standing aside is also a position. The crowd cannot tolerate standing aside. They equate activity with productivity. But the market does not pay for effort. It pays for alignment. I have seen traders ruin months of careful profit because they could not endure a quiet week. Can you endure it? Can you sit with cash and feel no urgency? Can you watch a stock move without you and remain calm because it did not meet your plan? That is strength. Wealth in trading is built not by constant motion, but by selective aggression. When your setup appears, clear trend, clean structure, volume confirmation, defined risk, you act without hesitation. But until then, you observe. Observation sharpens judgment. Over time, you begin to recognize patterns. Not just shapes on a chart, but behavior. How a stock reacts to news. How it behaves near support. How it trades at the open versus the close. You develop a feel, not a mystical sense, but a familiarity earned by study. And that familiarity tells you when the market is inviting you in. There is a rhythm to speculation, periods of expansion followed by contraction. Euphoria followed by caution. You must move with that rhythm, not against it. When volatility expands and price moves cleanly in one direction, you press. When volatility contracts and signals conflict, you reduce size or step aside. The market is always speaking. The question is whether you are patient enough to let it finish its sentence. Impatience is expensive. You may believe that waiting means missing opportunity. In truth, waiting filters opportunity. It separates the ordinary from the exceptional. It keeps your mind clear and your capital intact. The market rewards patience, not prediction. Now that may sound simple, but most men who come into speculation never truly accept it. They believe the man who can forecast tomorrow's price is the man who grows wealthy. They think success belongs to the one who knows what will happen next. But I learned long ago that the market does not pay for prophecy. It pays for positioning. Prediction is an ego game. Patience is a money game. Have you ever noticed how badly you want to be right? Not profitable, right? There is a difference. A man can be right about the general direction and still lose money because he moved too soon. He can predict a rise and buy before the market has finished declining. He can foresee a collapse and sell short while accumulation is still underway. He may eventually be proven correct, but his capital will not survive long enough to enjoy it. The market has no obligation to move when you think it should. A stock can remain undervalued far longer than you expect. A trend can persist long after it seems unreasonable. If you rely on prediction, you will constantly find yourself early, and being early in speculation is no different than being wrong. Patience, on the other hand, waits for proof. It waits for the chart to confirm the story. It waits for resistance to break with authority. It waits for support to fail decisively. It waits for volume to expand in the direction of the move. It waits for the market to demonstrate strength or weakness beyond doubt. Why guess when the evidence will eventually appear? The impatient trader sees a stock forming what might become a breakout and buys in anticipation. The patient trader waits until price actually clears the level and holds above it. The impatient trader fears missing out. The patient trader fears losing capital unnecessarily. Which man do you suppose survives longer? Speculation is not about catching the exact bottom or top. That is vanity. The real money is made in the middle of sustained moves, when the trend has already declared itself and continues with conviction. But to capture that middle, you must first endure the waiting. Waiting is difficult because it feels like inactivity, and inactivity feels like failure to the restless mind. The crowd believes money must be chased. They scan for hot tips, breaking news, sudden spikes. They feel compelled to act because others are acting. Have you ever felt that tug? That urge to enter simply because something is moving? That urge is the enemy of patience. The market spends much of its time building cores. Accumulation and distribution are processes, not events. A stock under quiet accumulation may drift sideways for weeks. Volume may contract. Volatility may narrow. Nothing appears exciting. Yet beneath that calm surface, ownership is changing hands from weak holders to strong ones. The impatient man grows bored and leaves. The patient man studies the structure and waits for the breakout. When the breakout finally comes, clean, forceful, supported by volume, the patient man is ready. He does not hesitate because he has done his work. He is not predicting. He is responding. That is the difference. Prediction attempts to impose your will upon the market. Patience aligns your action with the market's will. There were times when I believed I understood the market so well that I could anticipate every turn. I would analyze conditions, examine earnings, observe sentiment, and decide what ought to happen. But has no power on Wall Street. The market does what it does when it chooses. The tape taught me humility. A stock breaking above a long, standing range with expanding volume is not an opinion. It is evidence. A series of lower highs combined with heavy selling pressure is not a theory. It is behavior. Patience waits for behavior. Consider the broader market. When the major averages trend upward, forming higher highs and higher lows. When leading stocks break out and follow through. When pullbacks are shallow and buyers step in quickly. The market is telling you something. It is not whispering, it is declaring strength. Why would you need to predict an uptrend when it is already visible? Likewise, when rallies fail quickly, when leaders break down one by one, when volume expands on declines and contracts on advances, the market is revealing weakness. The patient trader reduces exposure. He does not argue. He does not forecast recovery. He observes deterioration and acts accordingly. Patience also governs position sizing. You do not commit heavily to a trade that lacks confirmation. You test the waters. If the market proves you right, you add. If it hesitates, you remain cautious. Let the market validate your decision before you increase your risk. Does that sound like prediction? Or does it sound like cooperation? Wealth in trading grows from compounding disciplined decisions. One strong trend can make your year if handled properly, but you must first be present with capital intact when that trend appears. That requires restraint during periods of confusion. Many traders exhaust themselves trying to forecast every minor fluctuation. They buy dips that have not finished dipping. They short rallies that have not finished rising. They confuse motion with opportunity. Patience filters noise. It teaches you to distinguish between a random fluctuation and a meaningful breakout. It teaches you to wait for the market to tip its hand. It teaches you that missing the first few points of a move is insignificant compared to capturing the bulk of a sustained trend. The market rewards patience because patience keeps you aligned with reality. It keeps your losses small and your capital ready. It prevents emotional decisions born from fear of missing out or the desire to prove intelligence. And when the right moment arrives, when price, volume, structure, and trend all point in the same direction, the patient trader acts with calm conviction. Not because he predicted the move, but because the market has already begun it. That is a hard truth for most speculators to swallow. The average man believes that if he is not in the market, he is not making progress. He feels that sitting with cash is the same as falling behind. But the market does not reward activity for its own sake. It rewards sound judgment exercised at the proper moment. A forced trade is born from restlessness. It is the trade you take because nothing else is happening. The trade you justify with thin reasoning. The trade you convince yourself is close enough to your rules. You see a chart that almost fits your criteria. Volume is nearly convincing. The breakout is nearly clean. The trend is nearly established. And so you step in. Have you ever noticed how often? Almost. Costs you money. The market is not a place for almost. It is a place for alignment. When structure, trend, and momentum are not clearly in agreement, you are gambling with inferior odds. And inferior odds, repeated often enough, will empty any account. The most dangerous trades are not the obvious reckless ones. They are the respectable, looking trades taken for the wrong reason. You tell yourself you are being proactive. You tell yourself opportunity favors the bold. But boldness without clarity is simply impatience in disguise. A forced trade usually begins with a feeling. Perhaps you missed a prior move. Perhaps you closed a winning position and now feel uncomfortable holding cash. Perhaps you have gone several days without action and feel out of rhythm. That discomfort builds. The mind starts searching for something, anything, to justify entry. Instead of asking, is this the best opportunity available? You begin asking, can I make this work? Do you see the difference? The first question demands quality. The second question bends standards. Every trader must have criteria, a defined setup, a pattern of behavior that has proven reliable over time. A specific way price must behave before capital is committed. If the setup is not present, there is no trade. That sounds simple, but simplicity is often the hardest discipline to maintain. A forced trade ignores that discipline. You buy before resistance is properly cleared. You short before support is convincingly broken. You enter during choppy consolidation because you are tired of waiting for expansion. You act in anticipation rather than confirmation. The market punishes anticipation more often than it rewards it. It is true that sometimes an early entry works. Sometimes a premature breakout continues. But speculation is not built on occasional luck. It is built on consistent edges. A method that works 7 times out of 10 must be protected. Forced trades dilute that edge. They introduce randomness. And randomness has no loyalty. The professional speculator understands that his capital is limited. His emotional energy is limited. His attention is limited. Every trade consumes all 3. Therefore, each position must justify its cost. If the chart does not present a clear structure, if volume does not confirm interest, if risk cannot be defined tightly, then the trade is too expensive. Standing aside costs nothing. A forced trade costs spread, commission, slippage, and often unnecessary loss. But beyond the financial cost, there is psychological cost. A poor entry weakens confidence. It disrupts focus. It tempts you to overtrade in an attempt to recover. One unnecessary trade often leads to another. Have you ever taken a mediocre position, watched it stall, and then searched for a second trade to compensate? That is how discipline erodes. That is how small errors multiply. The market offers periods of clarity and periods of confusion. During clarity, trends are clean. Breakouts follow through. Pullbacks respect structure. Risk can be measured. Those are the times to act decisively. During confusion, price whipsaws. Breakouts fail. News drives erratic movement. Signals contradict each other. That is the time to protect capital. A forced trade usually occurs during confusion. You convince yourself you see order in disorder. You project certainty onto uncertainty. Instead of admitting that conditions are unfavorable, you try to extract opportunity where none exists. There is strength in admitting that nothing is attractive. Cash is not idle. Cash is optionality. It is readiness. It is the ability to move when the real opportunity appears. If your account is tied up in marginal positions, you may miss the superior setup that arrives tomorrow. The market is generous over time. It provides trends. It provides breakouts. It provides climactic reversals. But it does not provide them on your schedule. Can you accept that? Can you endure a week without placing a trade if conditions do not justify it? Can you watch others boast of quick profits without feeling compelled to participate? Can you trust your plan enough to wait for alignment? These questions determine longevity. A forced trade often feels exciting at the beginning. There is action. There is movement. But excitement is rarely a sign of favorable odds. The best trades are usually obvious in hindsight because they were obvious in structure. Clean base, clear breakout, strong continuation, defined stop. They required patience, not persuasion. You should never have to talk yourself into a trade. The chart should persuade you on its own. Price should demonstrate strength or weakness beyond reasonable doubt. If you find yourself constructing elaborate explanations to justify entry, step back. The market does not need your creativity. It needs your discipline. Speculation is a business of selectivity. A businessman does not purchase inventory he does not need. He waits for favorable terms. He negotiates. He measures demand. Only then does he commit capital. A trader must think the same way. Not every day presents opportunity. Not every stock presents opportunity. Not every movement deserves participation. The skill lies not in constant engagement, but in precise engagement. No trade is better than a forced trade, because no loss is better than an unnecessary loss, because preserved capital compounds, because patience sharpens judgment, because discipline builds consistency. There is a difference between being drawn into a trade and running after one. That difference is often the difference between steady accumulation of wealth and steady erosion of capital. When price invites you in, it does so with clarity. It forms a base. It tests resistance. It tightens its range. Volume begins to expand at key levels. The market shows its hand gradually. It does not rush. It builds a case. And if you are patient, you can see that case develop before you ever commit a dollar. But when you chase, you are reacting to emotion, not evidence. Have you ever watched a stock surge suddenly and felt your pulse quicken? You tell yourself, if I don't get in now, I'll miss it. That thought alone should give you pause. Fear of missing out is not a strategy. It is a signal that you are about to abandon discipline. A move that is already extended rarely offers favorable risk. The stock may continue higher, yes, but where is your stop? Where is the logical point that proves you wrong? If you cannot define that clearly and tightly, you are not being invited. You are intruding. The market rewards entries near areas of structure, breakouts above established resistance, pullbacks into rising support within a confirmed uptrend, breakdowns below clear distribution zones. These are invitations because they provide context. They offer reference points. They allow you to measure risk against potential reward. Chasing removes that structure. When you buy after a large vertical move, your stop often lies far below. That means your risk is wide. And wide risk requires smaller size, which reduces meaningful gain even if the trade works. Worse still, many chased moves snap back quickly, shaking out the late entrants before resuming, or reversing entirely. Why do so many traders chase? Because momentum feels safe. A rising price appears strong. A falling price appears weak. The crowd piles in once the move is obvious. But by the time it is obvious to everyone, much of the low risk opportunity has already passed. The professional waits for the invitation. Consider a stock forming a well-defined consolidation after a prior advance. It moves sideways in a narrow range. Volume dries up. Sellers seem exhausted. Each small dip is bought. The range tightens like a spring. That is preparation. That is potential energy building. When price finally breaks above that range with decisive volume, that is the invitation. Risk can be placed just beneath the breakout level. If the move fails, you exit quickly with small loss. If it succeeds, you participate in the expansion phase. That is not chasing. That is responding. Chasing, by contrast, is buying the third or fourth large candle after the breakout, when price is already extended far above the base. You tell yourself strength begets strength. Sometimes it does, but more often than not, you are buying into short-term exhaustion. Do you want to be the first informed buyer or the last excited one? The same principle applies on the short side. When a stock breaks down from a clear distribution pattern, rallies weakly back toward broken support, and fails again, that is invitation. Structure supports the entry. Risk can be defined tightly above the failed level, but when you short after a sharp, emotional sell-off, you are chasing weakness. The market often snaps back violently after panic selling. The late shorts become fuel for the rebound. Price action is like conversation. It speaks in sequences, not in isolated bursts. Higher highs and higher lows signal strength. Lower highs and lower lows signal weakness. Consolidations signal balance between buyers and sellers. Breakouts and breakdowns signal imbalance. You must wait for imbalance. Chasing usually means entering during temporary imbalance without context. A news headline flashes, volume spikes. The stock leaps. You react, but headlines fade. Emotion fades. Structure remains. Ask yourself before every entry, is this move emerging from a clear pattern, or am I reacting to a sudden burst? An invitation is calm. It is deliberate. It aligns with trend. It respects support and resistance. It offers asymmetry, limited downside, meaningful upside. You can explain it simply. Price broke above this level, held it, and volume confirmed demand. Chasing requires justification. It requires optimism. It requires hope that momentum will continue long enough to save your late entry. Hope is expensive. When you chase, you surrender control of your entry price. You accept whatever the market offers in the heat of the moment. But control of entry is control of risk, and control of risk is survival. There were times when I chased. I would see a stock racing upward and convince myself that power like that could not stop. I would buy at elevated prices, only to endure sharp pullbacks that tested both capital and conviction. I learned that strength must be measured, not assumed. A true leader often offers multiple opportunities along its trend. Pullbacks to moving averages, breakouts from secondary consolidations, tight ranges within continuation patterns. There is no need to capture the entire move at once. Patience reveals better entries. The crowd believes that speed equals profit. In truth, precision equals profit. A well-timed entry near structural support within an uptrend can outperform a reckless entry at new highs without context. Price action must invite you in because invitation implies alignment. It means buyers and sellers have resolved a battle in favor of one side. It means probability has shifted measurably. It means you are stepping into a developing trend, not chasing a fleeting spike. If you find yourself thinking, "It's running away without me," remember that the market offers endless opportunities. Missing one extended move does not diminish your future, but participating in poorly timed entries can diminish your capital quickly. The disciplined trader watches, waits and studies. He tracks levels. He notes volume behavior. He observes how price reacts at key areas. And when those areas are decisively breached with confirmation, he acts. Not hurried, not desperate, invited. Chasing is emotional reaction. Invitation is structured response. And only one of those builds lasting wealth in speculation. Capital is ammunition. Spend it only when the odds lean clearly in your favor. A trader without capital is like a general without bullets. He may possess courage. He may possess intelligence. But without resources, he cannot engage. And in speculation, survival always precedes success. Most beginners treat capital casually. They divide it across trades without deep consideration. They risk large portions on uncertain setups. They expose themselves heavily during unclear market conditions. And when real opportunity finally appears, they are wounded, short of funds, or emotionally shaken. Capital must be respected. Every dollar in your account represents future opportunity. It represents optionality. It represents the ability to participate when conditions align. When you risk it recklessly, you are not just risking money. You are risking your seat at the table. Have you ever noticed how the market seems to present its best opportunities only after you have tied up your funds in mediocre ones? That is no coincidence. It is the cost of poor allocation. Spending capital requires selectivity. Not every chart deserves your risk. Not every breakout deserves your size. The odds must lean clearly in your favor. That means multiple factors aligning. Trend direction, volume confirmation, structural clarity, broader market support. If the general market is weak, why would you deploy large capital on aggressive long positions? If leading stocks are breaking down, why would you press new buys? The broader environment must cooperate. When the wind is at your back, you press. When it is in your face, you conserve. Speculation is not about constant engagement. It is about strategic engagement. A soldier does not fire blindly in all directions. He waits for a clear target. He conserves ammunition until it matters. So should a trader. Risk management is not merely about setting stop losses. It is about position sizing. A trade with modest edge deserves modest capital. A trade with strong alignment across time frames and sectors may justify greater size. The size of your position should reflect the clarity of the opportunity. But clarity is rare. Most days in the market are neutral, indecisive, mixed. During those periods, capital preservation is the correct posture. Cash is not a sign of fear. It is a sign of discipline. Do you feel uncomfortable holding cash? Many traders do. They believe idle capital is wasted capital. But idle capital is protected capital. It allows you to wait without pressure. It allows you to avoid marginal setups. It allows you to act decisively when probability improves. Capital also protects your psychology. Large drawdowns cloud judgment. When losses accumulate, fear creeps in. Doubt grows louder. You hesitate when you should act. You overreact when you should remain calm. By risking too much too often, you weaken not only your account but your clarity. Small, controlled losses are manageable. Catastrophic losses are crippling. If you treat capital as ammunition, you begin to think differently. Before entering a trade, you ask, is this target worthy of my resources? Is the trend established? Has price confirmed direction? Is volume expanding in the right way? Is risk clearly defined relative to reward? If the answers are uncertain, conserve. There will be times when conditions align strongly. A broad market breakout supported by strong breadth. Leading stocks emerging from sound bases. Pullbacks that respect rising support. Volume expanding across sectors. Those are moments when odds lean clearly in your favor. That is when you deploy. Not recklessly, not emotionally, but confidently.